Welcome back to our channel here at Le Risk Africa, your insurance and protection hub. And I, your host, Mindo, will take you through today's topic, which is the different types of life insurance policies. Life insurance, as I have realized, is one of those financial tools which are extremely misunderstood. And understandably why? Because for the longest time, especially in our Kenyan market, life insurance has been sold almost as an asset class, as an investment. Majority of you, when it comes to life insurance, the products it is that you have come across are education and endowment policies. That is your introduction to life insurance. But today's topic, we're going to go deeper to just understand from a fundamental perspective what this life insurance is, what it was actually meant to do, and how does it work. So let's start with something it is that we know. We know how harambes work. When someone passes away, we all as a community, as people who maybe loved this person, come together to contribute money so that we can be able to give the family to at least help them offset some expenses when, say, it is the breadwinner who's passed away or a family member who has passed away. So what happens in a harambe, we come together, everybody contributes what it is that they have, and the pot is collected and given to the affected family. When it comes to life insurance and insurance in general, think about it as an inverse harambe, an opposite harambe, because we understand that this risk of death is going to happen, right? We just don't know who and how, right? And when. So what happens is we remove this amount of money, this contribution beforehand, and it's going to be put into a pot. This pot is what is going to be given to the insurer. The insurer is now going to be the safekeeper of all this money in the pot. And then in the case someone passes away, the money is going to be taken away from that pot to take care of the affected family. So when people think that actually life insurance is individualistic, I'm like, no, not really. Because when it comes to life insurance, we have all contributed towards this family. It's just that maybe we might not know who it is that we have contributed to, but we've actually come through for this family. And let's use that analogy to understand the different terms when it comes to life insurance. So the amount of money that we contribute, the bits of money that we've contributed into that pot is what we call the premiums. This is what it is that you contribute every single month to give you a certain level of protection. The amount of money that will eventually be paid out to your family in the case of a death is what we call the sum assured. So when it comes to life insurance, just always remember that this is an amount of money that we already contribute beforehand through the premiums to release and to give access to the affected family if it was to happen. It's just easily the opposite of how a harambe works. So life insurance is a contract between you and the insurer. And this contract says that as long as you pay these premiums every single month, as we have agreed, there is going to be a payout in the case of a death. So what this essentially means in layman's terms is that we contribute a certain amount every month, and in the case of someone was to pass away, the life insurance obligation is to give that money to the affected family. And when it comes to life insurance, again, the other question is, why was it even created in the first place? So life insurance was created fundamentally to be able to replace someone's income when they pass away. Because remember, each and every one of us has an economic value. Because we earn an income, that means that there's a sort of value that we carry for the rest of our life. And in the case someone was to pass away prematurely, by prematurely, I mean there's still people who are dependent on your income. It means your economic value goes with you. That means all the future income you could have made in this lifetime goes with you. This is how we find that a lot of families, when someone dies, they literally have to start from scratch, because when the breadwinner goes, the income stops, but the bills do not stop. You still have to pay for the water, you still have to pay for electricity, school fees still has to be taken care of. But now when the income is gone, where is this money meant to come from? Yeah, that is why life insurance was created in the first place. But then eventually now with time, the product has been evolving, and now there is products which include like a savings element. There's others which include an investment element now, which we're going to go through when we talk about the different types of life insurance. So does life cover only pay out in the case of a death? Because as we have mentioned, that the main reason why life insurance was created was to create that economic value, or to replace that income in the case someone was to pass away and they were providing their income to a family, to their business, whatever it is, right? So no, life insurance also has living benefits that you can access when you are still alive. So what exactly are these living benefits? Number one, we have what we call critical illness cover. So critical illness cover pays out a lump sum in the case of a diagnosis of a critical illness, a severe illness like a cancer, a stroke, a heart attack, a coma, organ transplant, kidney failure. So you understand these are illnesses which a normal medical insurance might not be enough. And when someone gets diagnosed with this illness, there's still a bit of need of more money to be able to cater for the hospital bills, and also in addition to serve as an income replacement, because if you're to be this sick, most probably you can no longer continue going to work. So it makes sense for you to have this living benefit, so that in the case you were to be diagnosed with this illness, you will have a payout from the insurance company, so you can only focus on getting better. That's the first living benefit. The second living benefit is what we call a disability cover. So this one also pays out a lump sum in the case of an accidental disability, or a disability created by an illness. So in the case someone was to get a total and permanent disability. So what does a total and permanent disability mean? It means that you are completely, based on the definition, you can completely not do what it is that you're able to do before. So these are examples, like say you're paralyzed from the waist down, or you have lost 2 hands, you've lost 2 legs. You cannot do the activities you were able to do before. I will leave more information in the description box. So in the case this was to happen, you might not be able to work also for some time. So you need a bit of cushion so that you can be able to restructure your life, and also you can be able to maybe offset some of the medical bills that maybe brought about this disability in the first place. So the lump sum can be used to take care of the illness part, to take care of the bills, the hospital bills part, and also to serve as an income replacement, because this lump sum that you receive can easily be put in an investment product or an asset class, so that you can continue receiving some cash flow as you're stabilizing yourself. And this money can also be used, to buy, say, a wheelchair, or to be able to make changes in the house to now cater for this new reality. So what exactly are the different types of life cover, and what can you use them for? So today I'm going to talk about 5 main ones, and I will explain how exactly it is that they work and what it is that you can use it for. So number 1, we have term life insurance. This is the vanilla of all life insurances. It's the simplest one that is out there. So how does a life insurance work exactly? So a term life insurance protects you for a specific period of time. So what does that mean? It means that it gives protection, say for either 10 years, 20 years, 30 years, depending on what it is that you're comfortable with and what exactly was your goal. So in the case the death or the critical illness or the disability was to happen within that period of time, there is going to be a payout. In the case nothing has happened and the term is over, it means there's no payout. It works like any other simple insurance, say like a motor insurance. You see, if you buy a motor insurance for that 1 year, in the case something was to happen within that 1 year, there's going to be a payout. And say the 1 year is over and you have not renewed your motor insurance and you're to get into an accident, there's not going to be a payout because you are not on cover. So a very good example of a term life insurance is mortgage insurance. So how does a mortgage insurance work? Remember, when it comes to mortgage, you've gotten a loan to be able to pay for a house. Yeah, you've taken a mortgage for this house. So if you have, say, a 25-year mortgage, that means that there's a risk of death, disability, or critical illness within those 25 years. Because in the case any of those was to happen and you've not finished paying for the house, it means the bank can actually repossess the house and your family will be left out in the cold. So what do you do as a very smart person? You get mortgage insurance. So mortgage insurance will protect you for that period of time that you actually have the mortgage. Meaning that in the case of a death, disability, or critical illness, the amount that is received is going to be used to pay the bank so that your family can maintain the house. Yeah. And the reason why I'm bringing this up is because a lot of people feel that term life insurance is almost like a waste of money, because you put money in and then if you don't die, if nothing happens, it's like you've lost your money. But I want you to think of term life insurance like this. It's an equivalent of having a security guard. Say, for example, you've been living in your house for the last 15 years and you have a security guard for those 15 years and there's been absolutely no break-in. Will you actually say that the security guard was a waste of your money and your time? I really don't think so, right? So when it comes to term life insurance, remember it's meant to be there for a specific time for a specific purpose. Another way that you can use term life insurance is for other loans. If you've taken a loan, say for a 5-year loan, and you want to ensure that in the case of a death, disability, or critical illness, this loan can still be paid out so that, your creditors do not go into your estate, into your other assets to get their money back. It's just easier now to protect that loan using life insurance, a term life insurance. Or another way I've also used it before is, in the case now I'm planning for my children's education. I'm like, you know what? I'm currently growing my children's education for the next 16 years. And I want only protection for those 16 years only. So in the case of a death, disability, or critical illness, I want to make sure that there's an amount of money that will be paid into my children's education pot to be able to, still take care of the education needs. Because remember, right now we are in what we call a wealth accumulation stage. So in the case of, say, a death in year 5, it's really going to affect, as I said, all the future income. So in the case someone passes away in year 5, the amount of money that is received from the lump sum is going to be put into that pot and people can still continue living life as it was. So always remember, term life insurance is best for a goal that has a specific period of time. And it's important to remember that life insurance, when the term is over, then the cover is over. Although now in the market, there's an introduction of term life insurance where you can get a return of premium in the case there was no problem during that period. There was no death, there was no disability. So it means that the insurer can at least refund your premium. So it's really a bit more expensive, but this option is available. Let's go into whole life insurance. We've spoken about term life insurance, which only works for a specific period of time. But what if you're looking for something a bit more permanent, something that is going to last your lifetime? Because we know that death is definitely an eventuality. Is there a product that can ensure that whether someone is to pass away in the next 20 years, or if they're to pass away even at the age of 90, there is still going to be a payout? So yes, we have what we call a whole life cover. So a whole life cover is a permanent life cover. and it takes care of this risk for the rest of your life. What does that mean? It means that this is an assured payout because everybody is going to pass away one day. So the different whole life plans in the market, there's a whole life plan which someone can even choose also to pay for a specific period of time, and it will still cover someone for the rest of their life. Yeah. When it comes to whole life, how I look at it, yes, especially when you're looking into how can I use it? Because by the way, you have to remember you can have multiple life policies for different goals. So a whole life plan is very good for protection planning in the short run and inheritance planning in the long run. So let me give you an example. Say you have very young children right now. I personally have children who are aged 3 and 4. So this stage is when they are extremely vulnerable and they are going to be dependent on my income, say until maybe they are in their mid-20s. Maybe they are out of university, right? So I need to make sure that within that period, if anything was to happen to me, there is going to be an income replacement so that my children's lives are not interrupted. So how does a whole life plan come through in this situation? Because I need to make sure still my children can access food, clothes, shelter, whenever it is, whether I'm here or not, because it's my responsibility as a parent to take care of my children and to plan accordingly. So I can take out a whole life cover right now. I can say, okay, I want to take a whole life cover, and I know that it will take care of my kids until the age of 25, right? Because remember, it's a whole life cover, right? But say after the age of 25, because actually right now, because of really good medical care, people are actually living longer, right? So say that it's been now those 25 years and they don't necessarily really need my income at that time, because now the life insurance need has drastically reduced because they are not as vulnerable as say right now when they're 3 and 4. So any amount of money that comes after that can be used for estate planning, or it can be used as an additional into their inheritance pot. Because as we had mentioned, that this is an amount of money that will surely be paid out. So remember, whole life is good for protection planning in the short run and inheritance planning in the long run. It's a very good first step to estate planning, because the beauty about life insurance is the fact that it will not have to go through the courts. Because the one thing that is a big issue is, even if you have assets, even if you have investments, and you are to pass away prematurely or you get incapacitated, this whole thing has to be taken to the courts for the courts and the judges to decide how exactly your assets will be distributed. But you see, a life cover will give instant liquidity, so your children's or your family's lives do not have to be disrupted no matter what. So now let's get into what I know a lot of you know. Endowment and education policies. More or less the same thing, right? It's just that now when it comes to education policies, the main goal for saving using that plan is for your children's, say, higher education, whether it's for high school or primary school. So what exactly is an endowment policy? So an endowment policy is still a life insurance plan with a savings element. So think about it this way. It's like a protected savings. Yeah, think about it as a pot of your savings that is being protected over a period of time. So what it does is that it does pay out in the case of a death during that period that you have this policy for, or at maturity. So this one actually ends at a specific term, just like term life. It's just that now the only difference between term life and this one is that this one has a savings element to it. The term life is just pure protection, pure risk management tool. This one is a combination of both a protection and a savings plan. So you come and you say, okay, I have a goal for saving for my child's education and I want to use an endowment policy. So the one thing you have to remember is an endowment policy is, yes, a life insurance with a savings plan. So it's not as flexible as an investment, because life insurance, you actually have to ensure that you are able to maintain the premiums for the period of time that you have agreed with the insurer. Say you've taken a 17-year policy, 15-year policy, you should be able to pay for the premiums for that period of time. If you do not, there's chances that you can lose the policy, or there's also chances that the amount of money that you'll receive is less than it is that you expect. So most people use it as a way of disciplined savings, because of the lack of flexibility with these policies. And one thing that you have to remember is an education policy is still not an investment. Because remember, you get an investment so that you can be able to grow your wealth over a period of time. You're willing to take a risk for a possible higher return. But a life insurance plan like this endowment is actually a protected savings. It's a savings plan. It's a life insurance with a savings plan. So don't expect investment-like returns with endowment policies. Because if there's a place where we've had issues with a lot of Kenyans, is these policies, because majority of people don't understand. You have to remember, because life insurance is extremely long-term, sign on the dotted line when you fully understand. And you have to remember that you have to stick with this plan for the period of time that it is that you have planned with the insurer. And then also, it's very important to remember that you cannot pull out just whenever it is that you feel like it, right? And if you're doing it for disciplined savings purposes, you have to understand both the pros and the cons as you're getting to make this decision. The reason why we've been having a lot of problems with Kenyans and endowment policies is because majority of Kenyans have had these plans sold as an investment. So, you've been putting your money in for a period of time, your job ends, you're trying to pull it out, then you can't. You're told, by the way, this is a life insurance plan. You can't pull it out. So that is where now the contention starts. That is where now the friction starts, because people feel like they've been conned. They've not really understood what this was, and they feel that maybe the agent actually misguided them. So please always get in understanding fully what it's meant to do. And if you've come in and you said that I am looking into savings, and I know I cannot change this plan just the way I want, I cannot pull out, and you are comfortable with it, then go ahead with it. If it's something that you're not comfortable with, it's important to look at what are the alternative ways you can still save, you can still protect, so that it can give you that level of flexibility. Let's go to our fourth type of life insurance, which is a unit-linked life policy. So this one also offers a dual benefit of protections from a life insurance, and it also has an investment element towards it. So look at it this way. Out of every premium you contribute, part of it goes towards contributing towards the life insurance, and part of it goes towards the investment. This investment is usually now the unit trust, which you already can access on a day-to-day basis. The only difference is this one is now protected because you're buying it through life insurance. The difference between a unit-linked policy and, say, the endowment policy that I've just spoken about is just the endowment policy, remember, is a savings and the funds are guaranteed. But when it comes to unit-linked policy, the investment part of this policy, the funds are not guaranteed because it's an investment. It means that this part of your plan is actually exposed to the market, and it could either make money or not, because you are willing to take a higher risk for a possible higher return. So it means that you are exposing it to now the equity fund or a bond fund, which now we'll have a conversation on that in a different video. But remember that it's more or less going to be exposed to the stock market and the bonds market. And the thing is that, remember, even with how investments work, it could do well or it could not. So you are getting in, understanding the risk it is that you face, or hopefully you are understanding what risk it is that you face. So usually the protection element is not that high, because majority of people get into this policy because they want to grow their money over a period of time within a protected, or like within a fence, more or less, like within a pot that is protected. So how do people use these unit-linked plans when it comes to their overall, financial planning? So as I always say, before you even take any product out, it's important to have the end in mind, number one, and to understand the risks it is that you face. So people just take it as a way of diversifying, say, their investment portfolio. because, as I said, this one, a big chunk of it goes towards now the investment portfolio, towards now investing. So people just choose it as a way to more or less diversify and just to ensure that this is a plan where I am going to have my money still protected, but it is still growing. So usually, based on experience, the returns are not, they've not really been great. I've realized a lot of clients also get extremely disappointed because they didn't realize what it is that they're getting into. So you can imagine you've been contributing money for a period of time only to find out that maybe you've made less than what it is that you've put in. Because remember, it does not preserve capital because it's an investment and you've taken quite a high risk for a possible return. And remember, by the end of the period, because this one you also paid for a specific period of time, when the time was over, remember the life insurance part falls off, because if you didn't die, get a disability or a critical illness, the life insurance part falls off. What you'll receive is now the investment part of this policy. And depending on how the markets performed during the period of contribution, it will determine how much it is that you'll make at the end. So what do I think about it? This is one of those products which I say, proceed with caution, because remember, you don't even have that much control, obviously, over the market. And there's other ways of investing which I believe are much better. But at the end of the day, as I said, do what makes you most comfortable. Let's go to the final type of life insurance cover, which is called last expense, which can also be called a funeral benefit. So what this one does is that it pays out a lump sum when someone passes away to take care of the funeral expenses. And this one usually typically takes about 2 days after, receiving a burial permit. This is now to remove the pressure and the stress from the family when it comes to fundraising for funerals, or at least it will be able to contribute a huge chunk towards the funeral expenses, even as people are maybe still contributing through the communities. So a funeral expense is a very good addition also to, your overall portfolio, your life insurance portfolio. And it's important if you can even protect or cover your family members, because you can take one for yourself. It will take care of your funeral. In the case now you are to pass away, you can take one for you and your spouse and the kids, and even extended families. So usually this cover is extremely affordable, and you can take it as a group. It's actually much cheaper when you take it as a group. Think about it this way. Imagine if all of us had a funeral cover. It means that every time someone passes away, there's going to be instant access to cash without having to contribute every single time someone passes away. I think it's one of those things that we should actually consider. I understand that death is a very morbid conversation. It's something that we're not very comfortable having because, even when it comes to our own culture, our context, it's something we don't really like to think about, but it's something that happens. And it's something that actually does affect our finances, because every single time in the WhatsApp group someone passes away, we have to send an amount of money that is unexpected. But if everybody had a last expense benefit, it means that in the case someone was to pass away, that is instant access to funds to be able to take care of last expense and funeral benefits. Now, there we have it. We've spoken about the 5 different types of life cover. And remember, we can have more than one policy to take care of different goals. As I'd mentioned, you can have the last expense to take care of funeral benefits, whole life to ensure that you've left your kids an inheritance, a term life to take care of mortgage expenses in the case you're to pass away. So it's important for us to have a sit down to see what are your exact needs, who exactly depend on you, how much cover it is that we need, so that we can give you a plan specifically tailored for you that will ensure that your family's lives, your own life, your business will not be interrupted in the case of a death, disability, or critical illness. In the case you want a life cover from us, please click on the link in the description box below, and our able team is going to get back to you.